We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Kevin Wadsworth from NorthstarBadCharts.com. Kevin, how are you today? Thanks for joining me.
It's great to speak to you again, Tom. It's been a while, so it's great to catch up and looking forward to having a good chat about what's going on at the moment.
Absolutely. It's always a pleasure to speak with either you or Pat, either as a team or individually, and I always learn lots from you guys. But, before we hit record here this morning, we were kind of discussing this idea of really risk management and understanding the bets that you're making based on these technical indicators. This is something that, as you said, can turn a lot of people off, but when done properly, when understood properly, I think is a very serious and interesting tool to be able to use in these markets to guide you to be able to understand where some of these prices are ultimately heading, right?
Yeah, I mean, look, Tom, people are always looking for you. I mean, you're not going to get many clicks, likes, or views from sitting talking about risk and money management for very long, because people very quickly get bored about it. But it's seriously, if you're looking at this podcast now and you're thinking risk and money management, what the heck is that? How does it work? I'd really, really encourage you to study it and learn about it first before you start sticking, all of your life savings into stock X or, stock Y or, cryptocurrency Z or whatever it happens to be, because without risk and money management, you risk being completely wiped out, and you risk seeing your NAV, your portfolio, dwindling to just a tiny fraction of where you started. By using risk and money management protocols, which is stop losses, position sizing, all that kind of thing. And I'm not going to go into the details here because it'll just bore everybody rigid. But by using that on each trade, what you can do is gradually build your portfolio safely over time. I'm not a financial advisor. I'm a forecaster. I'm a qualified forecaster with decades of experience in the art of forecasting and the science of forecasting. But and I have to emphasize this, none of this is financial advice, but it's, something I'd strongly urge, and it's common sense, really. If you're not using risk and money management techniques in your trading, then I'm afraid you're very likely to get burnt badly at some point.
Mm-hmm. Well, that's the combination of the two is the important part, right? Is understanding what you are risking and understanding what the downside is, while understanding what your, let's say, target upside is.
Yeah, absolutely. I mean, it's all very well looking at a chart and pointing an arrow to the top right-hand corner of the chart and saying, it's going up there because because the narrative says it's going up there. That's great, and it kind of introduces bias and all sorts of things. But what you should be doing is observing your trade very closely, setting a stop loss so that it doesn't do what you think it's going to do. Then without any emotion, without any bias, you just step aside and you wait for the technical chart to evolve and develop and wait for the trade to come to you. There's no need to chase trades, whether it's cryptocurrencies or the stock market or NVIDIA, going up, 10% in a day or whatever. You should never have fear of missing out. There are trades all around us where you have great risk and reward setups. And if you don't really understand what risk and reward is, then it's, again, I'd encourage you to learn about that. It's a case of weighing up what the downside risk is versus the likely upside reward without being too greedy with your upside targets. We can all point an arrow up to new all-time highs and say, the stock market's going up to whatever value. But you need to use some kind of technique to actually estimate your target and not be too greedy about that target. You want to be exiting into strength. You want to be exiting that trade when people around you are saying, why are you exiting that trade? I'll use an example, and I don't think Pat will mind me talking about this. We exited Cameco a little while back, and that particular uranium trade had reached our measured move target. People were saying, well, why are you exiting Cameco? The uranium market's a great bull market, and there's all sorts of fundamental reasons why it's going up another gazillion %. Fact was, it had reached our measured move target. We'd grabbed the move that we wanted to. We'd taken a gain of, I think it was getting on for 70%. And that, perfectly happy with that gain almost 70% on that particular stock. But talking about those gains, that doesn't really mean anything. It's a question of what did your NAV go up by? And I think in that particular case, it's about 6%. So the NAV gain, if you've got a 100,000 portfolio, went up to 106,000 on that trade. So it's a 6% gain on that one trade. The fact that it went up 60 to 70% is irrelevant. And if you hear people talking about, I put on a trade and it went up 100% or 200%, you really need to see that as a red flag, because people focus on those numbers without ever actually saying, well, what was your risk? What was your reward? What was your position size? How did you achieve that? How did you play it? Because
did you get lucky?
Did you get lucky? Everyone gets lucky in a bull market. So, there are lots of red flags with technical analysts out there. And if they're talking about, just the gains of individual stocks, then that's it's a sign that they're probably not using risk and money management properly.
Mm-hmm. Well, it's interesting, let's say, the language that we've been using so far in this discussion, because really this is, as you said, it's boring stuff. It can be, it's not as exciting to think about this stuff as promising these crazy gains. But I think, another market that a lot of participants have either been bored by or overpromised has been the gold market. While it has been somewhat boring and we've been kind of trading sideways here for several months, we've been holding above this $2,000 level. So why don't we start with the gold chart, how you see it, and how you see this situation with many weekly closes or even monthly closes here above that $2,000 level, and what that structure starts to build.
Yeah, sure, Tom. I'm going to share my screen now, so hopefully you're seeing the chart that I've got on my screen here. And this is just an opener, just to set the scene. And people complain about gold and complain about it not doubling or tripling or quadrupling in value. That's not what gold does. We need to set expectations with gold. Gold tracks your loss of purchasing power, okay? So gold does it in surges. It'll surge and then it'll pull back. It'll surge, it'll pull back. So it's all about the timing. If you're going to be entering gold as a trader, it's about the timing. It's about spotting the important breakout, spotting the capital flows from the stock markets towards commodities and precious metals, and then playing that trade, like the period between 2000 and 2011, for example. But over the decades, this is what gold does. This chart is a representation of what gold has done for, well, quite frankly, centuries. 1, 2, 3,000 years, gold has done this. Your one gold coin will buy you much the same over the decades as it always has done. As an example of that, if you'd bought a house in the US in 1975, you'd have had to hand over 240 ounces of gold. Of course, gold back then was much cheaper than it is now, but I'm talking about the number of coins, gold coins, you need to hand over. Now today, if you've still got those 240 ounces of gold sitting in a basement somewhere, or if you've had a boating accident, you managed to find it at the bottom of the lake, then those same 240 ounces of gold will buy you a house. In the US, these are average house prices. So over that 50-year period, gold has done exactly what it is supposed to do. It's preserved loss of purchasing power. So, set your expectations about gold. Now, looking at the gold chart itself in detail, and everybody wants to chase the huge moves. Everybody's expecting big gains with a Z at the end of it, for example. everyone's yeah, exactly. And that's what gets the clicks, and that's what gets the attention. That's what gets everybody excited. When you get a major breakout like we saw back in 2019, if you go back through my social media feed, you'll be able to see that I projected the move from there to $2,000, followed by a large correction. Now that move and that whole process that took a number of years to complete was entirely predictable to the extent that you could weigh up the probabilities of various different scenarios. And the probabilities favored a move from this 1300 region up to 2000, followed by a very long, tedious correction and consolidation. And I posted that chart back in 2019, 2020. And we've been following that roadmap ever since. And this is what it looks like now. So we've built out a classic cup and handle pattern. This is the 2-week candle chart on the log scale. So each one of these candles represents 2 weeks of price action. Now, I know you've got a range of viewers watching these podcast. Some will understand technical analysis, some won't. But in essence, a cup and handle pattern is exactly what it says on the tin. It looks like a cup with a handle on it. Now, in technical analysis terms, when the handle is complete, it's a very, very bullish chart pattern. It's the end of a very long process that leads to the next bull market. So we're at the stage now with gold, having just broken out of the handle and making a little flag on top of the handle. So on the face of it, gold is building an incredibly bullish pattern, but there is a fly in the ointment here. There is a problem, and I'll go on to explain that. The gold chart, if you, instead of just drawing the handle on the cup in here, this is the cup and hand, that entire pattern there that goes back to what year does it go back to? 2010. If I just flip to this chart, back to this chart again, you can see that is this period inside the smaller cup which I've drawn here. The whole thing fits into a cup pattern, and so it's another way of analyzing this cup and handle is with two large arc patterns. Now that's fine, but the upper resistance line now goes all the way back to 2011, and that's kind of the last line in the sand that gold really needs to overcome. And that resistance line comes in somewhere around about 2070 or thereabouts. It's a little bit below $2,100. So until we're really above that, we're not quite in the clear for gold's long-term bull market to progress. We could quite easily see several months of further consolidation, and we'll know if that's going to be the case by observing this gold chart here and whether this flag pattern fails and breaks back down below this sort of 1970 to 1990 region. So this is a very good example of not jumping the gun too early, being patient and waiting for around about $2,100 on a monthly closing basis. And if you happen to be a stacker of precious metals, if you're stacking gold and silver, then that's absolutely fine. Anything around $2,000 or less is great. And with silver, anything around $25 or less is great as well. So, but for trading it and for trading the next big bull market move, which is going to take us up many, many hundreds of dollars, we're not there quite yet. The same can be said for silver. Whilst gold is sitting at its near its all-time highs, silver is nowhere near its all-time highs. It's about 50% off them and hasn't broken out on a technical basis. But the chart pattern, which I put in front of the social media audience back in 2019, the chart pattern is progressing very, very well. There's nothing about that cup and handle that is broken at the moment, and it's absolutely fine. You'll notice the March 2020 low produced a spike all the way down here. And what that means is that there is a second arc that is present here, and it's this one, which is defined by the wick on that candle. And you can see immediately what that does to the potential downside for silver. So again, until this is why we emphasize over and over and over again to anybody who's prepared to listen that you must wait for the confirmation. It's all very well having these bullish roadmaps, and Pat gets criticized for it a lot because he puts bullish roadmaps on social media, but he always identifies the breakout level, the level through which you must move before the upside potential is released. And people will always look back here in 1998. Silver was wanting to break out. People might have been getting excited because it moved up from $3.50 to $7. It had gone up 100%. But look what happened. It pulled all the way back and fell from $7 all the way back down to sort of $4, not far off a sort of 50% drop, a 40% drop. So until you get the confirmed breakout in what we call the evidence cluster, you find a whole range of evidence in here, moving averages, Ichimoku clouds, resistance lines. There's a cluster of evidence there. And this is where your weight of evidence comes in. You get the weight of evidence. And also behind all of this, you have to have the capital flows from the investment world, if you like, from what I'm talking about is the ratio of precious metals to the stock market. And precious metals never have a bull market without breaking out versus the S&P. So the ratio chart of gold and silver to the S&P is critical here. Until you get that breakout for gold versus the S&P, then it's not a tradable setup. It's not a tradable move. Great for stacking because you're getting your gold and silver at suppressed levels until it breaks out. but for anybody else, it's not the right environment. And you only have to look at precious metals miners versus gold to see what I'm talking about. So this is a chart of something called the ASA, the ASA index, and the ASA index tracks, or perhaps I should say the GDX index tracks ASA pretty much tick by tick. Okay, so if you look at the ASA chart and you pull up the GDX chart, they follow each other very, very closely. But the reason I'm using ASA is because it goes back 50 years. Okay, it's got much more price history. So what this chart is showing us is how precious metal miners, gold and silver miners, perform versus gold over time. Okay, what you can see is that precious metals miners, and this is the ASA index, I say GDX tracks it incredibly closely. The miners have lost 95% to gold over this period, and they continue to lose to gold over the long time frame. There are periods when you get an upsurge and the miners outperform the metal. But look, step back for a second and just realize that the periods of time when that is the case are very short. And even if we get this, it's a short period of time that you want to be in the miners rather than the metals. And here's another thing. Look at the last precious metals bull market. We know it took off in the year 2000. So that's just here. And we know it ended in 2011. And that's over here. Okay. Look what happened with the chart. The miners outperformed the metal because the chart's rising, and then the metal outperformed the miners. So that between 2000 and 2011, both the miners and the metal had performed equally because the chart ended up back exactly where it started. So the gains that the miners gained over the metals were completely given back by 2011. So the net result was that between 2000 and 2011, there was no advantage to being invested in the miners. One caveat to that is that you can use a ratio chart to spot the miners that are outperforming the ASA index. And we do this for our website members with, multiple markets, whether it's, precious metals or whether it's the uranium market or cryptocurrencies. You're able to use a ratio chart to pick out the handful of miners that are outperforming the ASA index. So if you want to be invested in a miner, pick the winning horse, pick the one that is outperforming the general index, and you can use the ratio charts to do that. And that's why the ratio charts come in extremely useful. But I just wanted to make that point that over time, it's very clear which is the winner when you're if you're going to hold something for 10, 20 years, don't let it be the miners. All sorts of issues around miners that gold doesn't have. Gold doesn't have issues with the price of oil increasing the cost of getting the metal out of the ground. Now, it seems to me that the miners are handing over one thing to get something that's a lot worse. They're handing over gold, which is legitimate currency. It's the ultimate currency in a way, and they're getting what they're getting in return. They're getting what, US dollars? That doesn't sound like a very good trade to me. Anyway, that's another conversation.
Yeah.
Well, so yeah,
yeah, Kev, it's interesting to be able to look, to these periods in time and hopefully be able to, identify when you want to be in these markets and when you want to be out of these markets. Something I always try to, have a proper perspective on is that we shouldn't be married to any of these investments or trades, right? As much as we, believe in the ideas of gold and what it represents for us as investors, I think it's important to step back and be able to say, there are times when you want to have, let's say, more of your net worth invested in it, and times when you want to, let's say, back that percentage of your portfolio off. And I think that is, again, that's not sexy or clicky to be able to talk about.
No, I mean, gold has a role to fulfill, doesn't it? And it's a hedge against a whole load of bad events. So if you're of the view that a geopolitical event is headed our way of some kind, or a financial crisis of some kind, currency issue of some kind, then gold and silver, precious metals, are physical. You've got them in your possession. They perform a role, and that role is, I think, very important, and may well become increasingly important over the next few years. I've got some more charts that might give you an indication of where this might be heading. Just before we do that, though, I think you wanted me to touch on uranium, and I'll just quickly touch on the uranium chart, because this is a sector that, again, if you go back through my social media feed, you'll be able to see that back in 2019 and 20, I got very excited about the uranium sector, and I took my positions in the sector at this precise breakout and back test here, and I was posting all over social media about it, again, for anybody that would listen. But what's happened here is we've had this evidence cluster by the chart carving out this perfect geometric arc, having a false breakdown in the COVID panic, and then a rapid upside reversal, and even a beautiful textbook back test. Now, if you're not a chart geek and you're not familiar with technical analysis, all of that will sound like complete voodoo and gobbledygook, and I'm sure you're going to get comments on this video saying, what's the guy talking about? It's all just mumbo jumbo. Well, I'm a scientist. My background is in science, and what I can tell you is that my training has enabled me to sort of see this in terms of almost kind of like physics, mathematics and physics. And what you're observing here is a shift in capital rotation from a very unloved sector back into the sector for whatever fundamental reasons. We don't need to know the fundamental story. All we need to do is observe the chart and observe that the chart broke down, and then something happened to cause that breakdown to be negated. And we got a little back test, a little check. The markets were just checking that this was a real bull market, if you like. And maybe it's the algos that do this. Maybe, it never ceases to amaze me, but we see it on chart after chart after chart, time after time after time. The chart breaks out above a resistance level and then comes back just to check it, make sure it's still there, and then off it goes. And you get a cluster of evidence here. It's not about one thing. It's not just about me looking at the chart and drawing some pretty lines and saying, well, okay, it's gone above my lines, so therefore it's a bull market. It's about the things that I can't control myself, like the 36-month moving average. Bull markets only happen when you're above a 3-year moving average. Bull markets also only happen when you're above the Ichimoku cloud, which is a technical indicator on the chart. It's this funny red and green cloud-looking thing, and it's used to project it's used to project support and resistance into the future. So you can see now where the support is on the Ichimoku cloud. You can also see the volume support, where all the trading volume is on the right-hand side of the chart. So what we're doing as a technical analyst, if you're doing it properly and you're doing it well, you're building a picture, you're building a weight of evidence that is giving you a probability, not a certainty, a probability of what is likely to happen. What's most likely to happen. If you know what's most likely to happen, even if it's only a 60% probability, and you've managed to identify that it's better than 50-50, then you can use that coupled with risk and money management. And what that then means is that actually most of your trades can fail. Okay, you can have 60 or 70% failure rate on your trades, but still make a profit. Mm-hmm. And that sounds ridiculous to say that you can have 60 or 70 or even 75% of your trades can fail. But the 25 that don't fail and that reach their targets, they completely wipe out your losses and put you in profit. Okay, so again, if you don't know what risk and money management is, if for no other reason than that, you should be studying it. But we had a renewed indication of a continuation breakout back here at the $23 to $24 level, and that was the only other entry point actually since the bull market started. So that was our entry point, and of course we've got this resistance zone we've got to work through now. So risk and money management means that we would exit the trade whilst we're still in profit if price continues to come down, and then re-enter on a breakout above this resistance zone, because that now is the clear point that we need to break out above to enact this target, which is somewhere between $46 and $50, and probably with an overshoot into the 50 to 65 area, and then a possible later target beyond that in the years ahead as we get sort of 2026, 2027. So as long as that roadmap continues to hold true, and as long as the price doesn't break below the edge of this arc, and perhaps more importantly, below the 3-year moving average, because the arc is something that I have drawn, and the 3-year moving average is something that the market has drawn for me. So the 3-year moving average is more important. And so as long as we remain above that 3-year moving average, and if we test it like last time, that's okay, but we have to remain above it. So that's how you use weight of evidence. That's how you use technical analysis, and that's how you use risk and money management to be winning even when you're losing.
Well, I think that's a really important point, is the idea of that risk management, right? Like you said, it's crazy to people to be able to think that you're going to lose on 70% of your trades and only win on 30%. But if you're using your risk management properly, that isn't going to kill you, because if you're using trailing stops, or you're identifying that downside risk and it breaks that target, then it's time to, take that trade off.
Yeah, trailing stops are certainly something that I think quite a lot of people use, and it's scaling in and scaling out is another technique as well. And so they're kind of variations and additions to the simple idea of risk and money management, where you set a stop loss at the point you enter the trade, you set your profit limit at the time you enter the trade, and you just let the trade run. And if it hits your stop loss, then so be it. You lose, well, in our case, we never risk more than 2% per trade. So, with 6 open trades, you would never lose more than 12% of your NAV if every single one of those goes wrong. But you only need 1 or 2 of those to work out. And even if the other 4 or 5 don't work out, then you're still in profit.
Kev, something that you touched on in that chart was this idea of volume, right? On the right-hand side. I wanted to get your thoughts on if volume gives you a different signal and how you use that.
Yeah, it's one and the same thing. So I'll just show this chart again. You'll notice this big bunch of trading volume here, buying and selling, that's going on in this zone here, and another zone down here. Okay, this kind of peak in the graph on the right-hand side, that's trading volume. The bigger the peak coming out of the right-hand side of the chart there, the more trading volume there is. And you'll notice that in this broad zone where all this trading volume is, it's where we're getting stuck. It's where I've marked the resistance zone. This whole area that we're in at the moment now is a little bit like trying to walk through molasses. You can sort of move, but you're kind of struggling. As soon as you break free of that trading volume, then you tend to move up more freely and more rapidly. And the same down here. You see this trading volume here down at the bottom. And so the support and resistance lines on the chart, and quite often other technical analysis, coincides with these little peaks in the trading volume. Each time you get above a peak in the trading volume, you're also breaking above a resistance line. So it's the same thing. The resistance lines are created by the trading, because it's the trading that's moving these candles, and it's the candles that create the resistance lines. So really, when you're putting resistance lines, horizontal resistance lines on a chart, all you're doing is you're identifying where the volume is. So if you use TradingView or one of the other sort of trading platforms, then displaying your trading volume by price as well as by time at the bottom here, by putting trading volume by price, it helps you sometimes just locate where those resistance lines should be. If you're struggling to know where the main resistance line is, it'll usually coincide with one of the peaks on this trading volume, and getting above that means that you're turning that from resistance into support, which is really important from a technical chart trader's point of view. I wanted to sort of talk about where all this is going, because I think the last time we spoke, I was probably quite bearish on the stock market, and I think quite a lot of people were. And it's important to say at this point that we have not been shorting the stock market. We've not had any particular positions in the stock market because of reservations about what the stock market is doing at the moment. But I think it's becoming a lot clearer where we're going with the stock market, and therefore probably also with cryptocurrencies. And it hasn't, to my mind, the evidence has been quite evenly distributed over the last several months with stock markets and cryptocurrencies. But I think these charts, I'll just show you this next set of charts, and I'll give you an idea of where I think we're likely to be going. This is the US government bonds 10-year yield. So when the bond yields are going up, bonds themselves are not, but basically the yield does the opposite to what the bond does. Okay, so 10-year yield goes up, then you're in a bond bear market effectively. So government bonds, or sorry, I should say government bond yields, have been in a 30, 40-year downtrend since 1980. In fact, it's more than 40 years. And the 10-year yield was contained below what I call the pain line. Okay, and I called it the pain line because to my simplistic way of viewing it, and I'm not an economist, when the 10-year yield breaks out above the pain line, something bad is likely to happen. Bad, why? Well, bad because there's a reason why that pain line is there. It's there because of debt to GDP, effectively. It's there because we've got a growing national debt, okay, and there's a burden of paying the interest on that debt. And the interest on that debt is determined by the yields on government bonds, whether it's a 2-year yield, a 10-year yield, a 30-year yield. And they've all been in multi-decade downtrends, and they've all broken out. So breaking out above there makes me think that there's a financial conundrum where meeting the debt obligations, the interest payments on the debt, are going to be problematic, because every time in the last 40 years that this chart has tried to break out, it's been pushed back down until it got pushed back down so far that 0%. How long can you sustain that? Mm-hmm. And the rapid upside reversal, so false breakdown, rapid upside reversal, led me back in 2020 to tell again anyone that would listen that we're entering a new paradigm. And I got a lot of stick at the time from people saying, well, you're using very sensational terminology there, saying we're entering a new paradigm. Well, there are one, two, three. There's 4 paradigms on this chart. One back here in the pre-1954, when we were below the pain line and we broke out. And then we had a couple of decades leading up, particularly through the 1970s, of rapidly rising bond yields and interest rates. Now, that was possible, I suppose, because GDP was falling from 70 to 31%, and the Fed funds rate rose from 1.4 to 16 points. I should say debt to GDP fell from 70 to 31%, and Fed funds rates rose from 1.4 to 16.39%. So what I'm saying there is that debt to GDP was dropping, so the problem was decreasing as rates were rising. So that kind of mathematically seems doable. But what's happened since 1980 is that debt to GDP has risen from 30-odd% to around about 130%. The Fed funds rate had to drop to make that sustainable. It had to drop from 16.39 to nearly 0 because of the debt to GDP rising so much. That's what kept our debt repayments feasible.
Manageable, yeah.
But now it seems to me that they're not feasible. We are above that resistance line, and to me, that resistance line is the point at which things become unsustainable in the longer term. There's a couple of indicators at the bottom here that show you very clearly the trend changes from bear markets in bond yields to bull markets in bond yields. One of these is the distance from moving average, and the other one is the rate of change analysis. So we've just triggered a new trend change, a new paradigm into the 4th paradigm. And this is another paradigm like late 1950s, 60s, and 70s, where we had year after year after year after year of bond yields and interest rates rising. Yes, there were some very significant and strong pullbacks, and I've indicated on this chart that we may very well see one of those, but it doesn't change, I don't think, the paradigm that we're in. So the ProShares Inflation Expectations ETF, this is the way I analyze inflation expectations going forwards, and we've broken out through this cluster of evidence bull market stage 1, bull market stage 2 when we cross this next threshold. So for me, we're now in a paradigm of surprising inflation, but not surprising to me, but surprising to perhaps a lot of analysts, where they'll come up with all sorts of narratives as to why inflation is proving problematic and eventually scarily high, I suspect. And this sort of leads to another issue which we have with the yield curve inversion.
Well, Kev, if we could just go back to the last chart for a sec.
Yeah.
I think this is a really important point, and obviously, using the term paradigm shift for the change in that chart, I think is easily, I don't even think is generous language. There is an absolute sea change in the behavior of that market, right? However, thinking about the ramifications of it, I think is such a conundrum, because on one hand, when we're discussing, inflation, for example, if the Fed sees inflation ticking back up, you'd think that at very least they're going to hold rates where they are, if not increase rates again, because many times Powell has evoked the ghost of Paul Volcker, right? To be able to beat this inflation boogeyman that everybody is suffering from. However, on the other side of this, as you very astutely pointed out, we have this situation where the government is going to have to keep rolling over this debt at higher and higher rates that doesn't seem manageable, right? Now we're going to have very likely falling GDP with growing debt again. And that is a very, untenable situation where it ends up kind of really putting the Fed in between a rock and a hard place, because on one hand, they're going to need to cut to be able to service the debt. However, on the other hand, they have to be able to keep this inflation fight up. So it's going to be a really difficult time for the Fed and for these markets to be able to understand what's going to happen here.
Yeah, I mean, there's one way out of this, of course. One part of the equation that would ease the problem is if GDP rises rapidly. Then that would cause debt to GDP to drop and make it possible to raise rates and kill inflation. So the US needs GDP to rise rapidly to have a solution to this. And I'll maybe leave that to your imagination as to how they might want to do that. That is really the only part of the equation that might save the whole thing from falling apart at the seams. I mean, it probably will anyway in some form or another. But mathematically speaking, and I just look at this from a very black and white perspective, mathematically speaking, I don't need to know all the narratives. I'm not really interested in all of that. The chart speaks for itself, and it has done for a good number of years now. Trouble is, of course, that the audience who are listening get very weary of hearing this over and over again, because commentators have been saying for years that this is coming and that a terrible event is heading our way and debt's unsustainable and all that kind of stuff. But having this chart, it helps you position yourself. It helps you have awareness of what's going on around. What I'm trying to say is, not very well, is that you have a feeling over the last several years that something not great is coming. But having this visual chart, it makes it very clear when you cross that threshold and puts you into a new environment. We crossed this 12-year moving average, which has only turned up once in the last 100 years. The last time the 12-year moving average turned up was in the 1950s. It rose through the 1970s. Then it's been falling for decades and decades and decades, and now it's turned up very sharply. And that's only happened once in the last 100 years. So that's something, when something happens that doesn't happen more than once a century, you need to sit up and take notice.
Again, kind of
for sure.
reinforcing that idea of a real paradigm shift.
Absolutely. Yeah. I mean, it's undeniable now. We are in a new paradigm. It's just that, it's a frogs in a boiling pot scenario, isn't it? People haven't quite picked up on it yet.
And again, this is something that is very helpful to look at over a long-term chart like this. We're looking back over basically 100 years of interest rates and yields to be able to explain and understand what happened and when, and the actual play out or playbook of those events. And that
well, absolutely. And you have to look at the big picture, because if you don't, it's a little bit like, being a doctor and a patient walking in and, a whole range of symptoms, and the doctor only being able to look at your little finger. If you're just looking at what's been going on in the last, let's say 10 years on a chart, you're missing the big picture.
Mm-hmm.
You can't diagnose somebody who's got, a complex illness by just visually examining their little finger. You need to go into a lot more detail and look at the big picture. And it's no different with technical chart analysis. If you want to know what's happening in the grand scheme of things, and the big forces that are at play, then you need to look at 100 years worth of data, or at least the maximum amount of data that you have available to you. Of course, the charts don't always go back 100 years, especially if you're looking at something like cryptocurrencies, of course. But the more data you can look at, the better. Mm-hmm. So just kind of this chart, I'll just zip past this chart, but it just shows you very quickly how things have performed over this century. People complain about gold a lot, but look, it's up nearly 600%. Even silver's up 350%, and the S&P is up 288%. So, for anyone that's been investing in the last 20 years, or like me, started in the early part of this century with serious investing, then you haven't really got much to complain about. And it's all about timing. Mm-hmm. If you start this chart at a different point, say you start it in 1980, or, you start it in 2010, then the returns are very different. Mm-hmm. So it's all to do with timing. But, so far this century, those are your results. So, if you hear people whinging and whining about, gold hasn't done very well, they probably just didn't get their timing right, did they? And that's what these charts help you with. It helps you with the timing. Now, this is what I wanted to get around to, and the timing of where we might have some problems. This is a chart for NVIDIA, and it's a 1 point. Wow. Blooming heck. Sorry, it's not often I'm lost for words, but I put a chart out this morning on Twitter saying that this has got a market cap of 1.67 trillion. And I'm just looking down there in the bottom right-hand corner of the screen. It now has a market cap of nearly 2 trillion.
Wow.
It's absolutely staggering. Yeah, NVIDIA is up 15% today. So what I was going to get round to is that we have a support line for the move up with NVIDIA, and NVIDIA and charts and companies like it. And there's half a dozen, 7 major leaders in the Nasdaq, the S&P, the stock market. They're doing a lot of the heavy lifting, it has to be said, for the stock market at the moment. And if one of these multi-billion, or in fact in this case, rapidly becoming multi-trillion-dollar companies, was to start to decline, then it would have a massive effect on the overall markets, of course. Now, NVIDIA has carved out what we call a bearish rising wedge, or is starting to carve out a bearish rising wedge. It has 3 touch points on the lower support line. The upper resistance line only has 2 so far, so it's technically not a valid resistance line yet. That has to be said. But it gives us an estimate as to where we're going to find major resistance by joining these 2 major sort of peaks here. And believe it or not, we could be getting up to somewhere close to 1,000. I say believe it or not, but it's probably quite believable because it's only 25% or so above where we are at the moment. So it is entirely believable. But I anticipate that NVIDIA is going to grind its way up towards 1,000, or if it takes until later in the year and follows this support line until November to reach somewhere perhaps around 1,300. The support line reaches the resistance line in November, which I found interesting because we all know what is happening in the United States in November. So perhaps a day or a week after the election, this whole thing just collapses in a pile of dust and falls 77%. So I'm not saying that is going to happen. The charts will have to confirm the breakdown first. But in terms of timing and technical chart evidence, what I'm trying to say is that the stock market, don't short the stock market when it's in beast mode. And clearly, when we're in this stock is in beast mode at the moment. A multi-trillion-dollar company going up by 15% in a day is, I don't know how often that happens.
It reminds me of a tweet from Dave Collum the other day. He said, no overvalued market or asset class ever stayed overvalued. Not a single one.
No.
and you're just providing the roadmap here for that.
Yes, and here's another roadmap for you, Tom, which might be my final chart, I think. Maybe. This is the yield curve inversion chart. And people seem to like this one because I've got a risk matrix in the top left-hand corner there. And this is the risk matrix that we used in the UK Met Office when we're issuing severe weather warnings for floods or for wildfire or whatever it happens to be. And I just want to explain this because it might help people to understand how to assess risk. Risk is defined by the likelihood of an event and the impact that that event would have should it happen. This is how emergency responders analyze risk here in the UK, and I think in most developed countries around the world. Risk is analysed in that way. It's a combination of likelihood and impact, and it's used for the National Risk Register. So the UK and other developed countries have something called a National Risk Register, and this is what my work involved. When I worked for the Met Office, I wasn't standing up there waving my arms around on TV saying it's going to rain tomorrow or whatever. I was involved in doing risk analysis work for emergency response and also forecasting for the Royal Air Force for their flying sorties around the world. But in this context and applying it to technical chart analysis, and it works, I think, really well in trying to convey the message because it uses a simple color scheme, green, yellow, orange, and red, which most people are probably familiar with sort of traffic light based systems where red means danger. I'll explain the chart underneath. This is the 10-year yield minus the 2-year yield, and it's usually a positive number because forward inflation expectations are higher than shorter inflation expectations. So in other words, inflation has been quite low over on average over the years, maybe 2 or 3%. It's always the target around there, isn't it? And at those sort of lowish levels, the natural line of thinking is that, well, at some point in the future, inflation is probably going to be higher than it is now. So the 10-year yield needs to pay a greater rate of interest than the 2-year yield to encourage people to hold something for that long. Okay, so that's fine. That's the normal situation. You can see that 99% of this chart is above the 0 line. It's above the red line. That means the 10-year yield minus the 2-year yield is a positive number. Great, that's the normal situation. But there are occasions when the 10-year yield minus the 2-year yield is a negative number and the chart dips below that red 0 line. And that has obviously happened just recently. And it means that the 10-year yield minus the 2 is a negative number. So, for example, the 10-year yield might be, say, 5%, but the 2-year yield is 6 or 7%. And that's gives you a negative number because 5 minus 7 is minus 2, of course. And that's during periods of raised inflation. And you'll be aware that inflation has been a problem recently. Short-term inflationary expectations have been high because, well, we've had high inflation and it's been going up until recently. So that's the situation we've been in just over the last year or two, rising inflation in the short term. So therefore, that's pushed the curve below 0, and that's an inverted yield curve. Okay, so what's known as an inverted yield curve. Now, at some point, the yield curve uninverts, and inevitably, the normal situation begins to reassert itself, and longer-term inflation expectations will outpace shorter-term inflation expectations. That's the normal, perfectly normal situation. But look what happens every time we interact with the zero line. Every time, and particularly every time with major crisis. Yeah. Now I'm a technical chart analyst using meteorological techniques to show the likelihood of future directions. So that's my area of expertise. I'm not an economist, so I'm not going to sit here and tell you why that happens. I'm sure somebody might say in the comments why this happens and come up with some good explanations and reasons. But sitting here trying to explain it now is going to make my head explode. So I'll be perfectly honest about that, and I'm not going to stray beyond my area of expertise. That's something I've learned very, very definitely not to do. But this chart very plainly does say that something is coming, and when it does, it's probably going to be given a name of some sort. I've heard the Market Sniper talking about this. I know you've interviewed Market Sniper on this type of subject on a number of occasions. Know him very well.
Actually, exactly what this chart made me think of was.
Yes,
was
he's been saying the same thing. Yeah, exactly. And I mean, this chart is reasonably well known, but not very well understood, I don't think. So I'm just doing my best here to try and explain what the chart is telling us, and to try and cut to the chase, really, because if we cut to the chase, you know, when this chart interacts with the zero line and rises through it, we got a problem. And if that coincides with the stock markets showing signs of there being a problem, NVIDIA topping, rolling over, breaking down, NASDAQ doing the same, warning signs coming from other markets, precious metals. What's happened in the past is that when this event happens, there's a sell-off, a broad market sell-off that takes pretty much everything down. Gold can drift downwards by 20 or 30% over the course of a year, for example. I think it did that in the early 2000, around about the year 2000 or 1999, around about that period. And so that would be normal. But the roadmap would be that from that point, the stock markets are going to have a sort of a lost decade. That's what happened between 2000, and people forget that we had 10 to 15 years between 2000 and sort of 10 to 15, where the stock markets went absolutely nowhere. People forget that. And what did gold do during that period? It went up by 800%. In fact, I've got a chart here that shows you that. NASDAQ, 2001 to 2012, went absolutely nowhere. The NASDAQ chart is this bar chart. 12 years of doing absolutely nothing. And gold between 2001 and 2012 went up 800%. So
going back to our discussion on timing.
Exactly. Timing is absolutely everything, and recognizing the signals that the market is giving you is also very important. And do not fall for narratives. Whenever anybody says to you that the US dollar index needs to go down for gold to go up, well, just show them this chart, because between 1980 and 2004, DXY went down and the gold price did much the same. In 2004 to now, you've got DXY rising, but what does gold do? What does gold do when the US dollar index goes from 88 to 104 since 2018? Well, in that period since 2018, it's gone up $700. And in the overall period from 2004, whilst DXY has risen, gold has gone up from, what is it on the left-hand scale there, somewhere around about $500 all the way up to $2,000. So over time, and why is this? It's because the US dollar index is contained within a range. The US dollar index is just an index that's measuring the relative strength or weakness of the dollar versus the euro, effectively. So it's contained within a range. So you get fluctuations in the US dollar index, but whilst those fluctuations have some correlation to short-term movements for precious metals, over the long term, gold doesn't give a damn what the US dollar index is doing. Gold tracks your loss of purchasing power. that's it. That's what gold does. It tracks your loss of purchasing power. So getting back finally to this risk matrix, the event when it happens will be a high impact event. Of that, I'm pretty certain, because history has told us it's going to be a high impact event. So high impact event, that's the right-hand column. We are automatically in right-hand column. We are currently at a low likelihood of a high impact event because we have not yet interacted with that red line and the stock market is not rolling over. As we get closer to that stock market target and NVIDIA target, for example, and as this progresses closer to the red line, the impact matrix, check in the box, will move up to a medium likelihood of a high impact event. And this matrix, which is obviously shown to our website members every week, is designed to give you a short notice. It's meant to say what's going to happen in the next several weeks to perhaps a couple of months. So there's no point moving this check in the box up there now, because there's no evidence that this is going to happen in the next few weeks or the next couple of months. It could be towards the end of the year. So we're sitting at the moment on a high alert, ready, and in the knowledge that this is headed our way. But the assessment at the moment is a low likelihood event. It's low likelihood in terms of, is it going to happen in the next few weeks? So it's going to be a high impact event, but just not, we're not anticipating it right around the corner. It's a little bit of a distance off yet. That's how I'm interpreting the chart.
Which again, going back to our NVIDIA chart as well, that really is pulling a lot of the stock market along with it, coinciding with, towards the end of the year here, it's going to be, probably a very tumultuous time just from this charting perspective, along with whatever ends up happening in the election.
And it makes it difficult for gold to break out versus the S&P. A major part of our evidence case for going long precious metals in terms of trading, I'm not talking about stacking precious metals, I'm talking about trading. A large part of the evidence case is gold breaking out versus the S&P, as it has done in every bull market in the last 50 years. So whilst gold can drift upwards with the stock market going up quicker, that would mean that the gold doesn't break out versus the S&P. So I'm not saying gold is going to go down necessarily. What I'm saying is that for the real bull market to begin and to be really underway properly, it needs to break out versus the S&P. And the reason for that is because you need the capital flows. You need the capital to be attracted towards precious metals, commodities, and all of those things. And that's not going to happen until you get the flows from the S&P. And that's what history has shown us every single time. And I don't suppose it's going to be any different this time. Gold can drift upwards. It can slowly move up, just not as quickly as the stock market. So, relatively speaking, investment in the stock market will be greater than in gold. But as soon as that ratio breaks in the opposite direction, then it's go time for precious metals.
Again, just showing that weight of evidence for the metals and when it's really time to pay attention to it and be maybe adding to your positions rather than keeping them at maintenance levels.
Yeah, and fear of missing out is a terrible thing. And people think that if gold goes to $2,100, oh my gosh, am I going to miss the move? I need to be in now. Forget that. $2,100, $2,500, $3,000, that doesn't even scratch the surface. Think about it for a second. Gold moved from 250 to 2,000 in the space of 10 years in the last bull run. And in the previous bull run, in the 1970s, gold doubled, then it doubled again, then it doubled again, then it doubled again, then it doubled again, then it went up some more. So we haven't even doubled yet. From $1,500 or from from where we are now, sort of breaking out of that handle, nothing's happened yet. Even if we go up to $2,500, you're really at the early stages of what's coming. You as a minimum, you would expect in an average gold bull run for this to go to 10,000. And that's being conservative. People will say $10,000. What kind of world are we going to live in if gold is $10,000? Well, if you'd said to people back when gold was $250 that it was going to 2,000, they'd have said the same thing. And what's the answer? Well, the answer is inflation. Gold is reflecting your loss of purchasing power. And it's as simple as that. How much purchasing power have we lost in the last few years? Gold is always tracks that. Okay, over time it tracks it. And that's all you need to remember. And observe the charts, observe the breakouts, observe the capital flows, the weight of evidence. And if you're trading it, use risk and money management. If you're a convicted, if you're a stacker with conviction, and nobody's going to tell you otherwise, and you stack your gold and silver, and over time, that's proven to be a perfectly good thing to do, because you can buy that house for the same price now as it was 50 years ago. If you're an advocate of sound money and gold, you're not paying any more for that house now than you were 50 years ago. It's the same price. It's an illusion. Nothing's gone up in price. Nothing's gone up. It's that dollar that you're holding in your hand, that's been turned into almost nothing now. It's lost 97% of its purchasing power. Nothing's going up. It's your dollar that's going down. Don't think of it as prices of things going up. It's your purchasing power that's going down, and that is what gold saves you from.
Yeah, it's a really important point, Kevin, and one worth, I think, spending some time speaking about as we've done here today, because again, it's just this reflection of the loss of purchasing power, not necessarily, your house or the actual cost going up. And, going back to that chart that we were looking at, the DXY versus gold, that's not necessarily a properly reflective chart of the value of a dollar. That's just a value of a dollar against a bunch of other fiat currencies. Against
which are all going down the toilet versus gold, aren't they?
Exactly.
If you plot all of those currencies against gold, that gold is moving from the bottom left to the top right versus those currencies.
And I suspect if we used a chart of, let's say, M2 money supply, or obviously inflation adjusted value of a dollar, the chart would be a lot more of an inverse correlation to each other. But, again, worth keeping in mind that these are just comparisons, really, and ratios against different assets. And we don't necessarily need the DXY, which is a basket of comparative fiat notes against each other, to go down for gold to move.
You don't. You definitely don't. But what is very useful is to note that when gold breaks out versus DXY, that is another piece of evidence for a precious metals bull market, because what that's doing, and it's hard to explain this, but when gold breaks out versus DXY, what it means is that gold is outperforming the US dollar's relative performance versus those other currencies. So however strong the dollar is, if gold is breaking out versus DXY, then gold has the upper hand. And that's telling you that the tailwinds are with you for a precious metals bull market. It's one piece of evidence, but it's a piece of evidence that gets added to the pile of evidence. Gold breaking out versus the S&P, gold breaking out versus inflation, gold breaking out versus the NASDAQ, gold breaking out versus M2 money supply. All of these things, when you look back at each gold bull market, they all happen simultaneously. I say simultaneously, not on the same day or the same week, but they happen in the same time frame. And when they all happen, and you've ticked off all those boxes, and they've all, gold's broken out versus all of them, then you've got high confidence. Trading's about confidence. Forecasting is about confidence levels. People think you have to have 100% confidence or 0% confidence. Amateur technical analysts are all over social media, and they say, stock X is going to do this. Gold is going to do that. That terminology is wrong. It's fundamentally wrong. You can never say, I can't say what gold is going to do. I say what it's most likely to do, what the probabilities suggest, and I provide a roadmap, and that roadmap remains in place until one of the support lines is broken to the downside. So that roadmap comes out of those probabilities. That gold chart and silver chart, all these charts that I've shown you, they come out of a constant analysis of the probabilistic direction of those charts. And there are times, Tom, when you can't be very confident about what's going to happen. over the last 6 or 12 months, I'll be the first to admit I haven't been very confident about what the stock market was going to do. It's been all over the place. It had a big breakdown, then it's moved up, and then it's moved up. The stock market has been a challenge, and I've found cryptocurrencies a bit of a challenge as well, because the probabilities have been quite evenly spread for a number of reasons until very recently, particularly for cryptocurrencies. Also, getting that risk reward calculation has proved quite difficult as well on many occasions with things like Bitcoin and Ethereum. Finding a good swing low to anchor your stop loss on, all that kind of thing, when you're doing it on a monthly time frame. And also, there are lots of other charts out there that give 3 or 4 to 1 risk to reward ratios, not just the stock market or cryptocurrencies or whatever happens to be flavor of the month at the moment. And of course, we've spoken about the miners, and precious metals miners are in the dumps, and they may well stay there for several more months. But at some point, they're going to put in a capitulation low that is going to be quite, hopefully, I think, quite easily identifiable on the charts. And at that point, if you're seeking value, if you're one of these traders, investors trying to catch the bottom, then that would be a good signal. Of course, with my trading framework, I wait for a proven breakout. I don't trust the chart until it's proved to me the direction that's going to go in. And it can only do that by breaking out through these evidence levels that I've spoken about. So it depends on your own trading framework, but whatever your trading framework, stick with it and use risk and money. I must have said that about 16 times so far. Use risk and money management, because if you don't, you're going to probably regret it.
Well, Kev, I think we touched on a lot of important topics, and I hope our listeners get some value from this. I know, again, A, it's not the sexiest stuff, but it is extremely important. But B, we've talked about this many times, and I think both of our thoughts are becoming more refined on this. And I really appreciate all of the charts and the data that you laid out for us today to be able to really walk us through how you're seeing these things and how they're developing.
Yeah, you're welcome as always, Tom. It's always nice to talk it through. I'm not here for the clicks. I'm not here for media stardom and all that kind of stuff. It doesn't really interest me. I approach this from a very scientific angle, a very sort of methodical angle, and that's just the way that Pat and I want to approach this. We want to make it very clear to people what the downside risks are, what the upside rewards are, and we want to have longevity in this space and not make outlandish claims and not kind of fall foul of some of the pitfalls that often do people fall foul of, the mistakes that are made, people make. And as I say, with a background in forecasting and analysis, maybe have a little bit of an advantage from that point of view. But it's fascinating stuff with the stock markets and precious metals and where all this is heading. I do find it, every day is, I enjoy sitting in front of the screen and tracking all of this. It doesn't feel like a work to me. It feels, I enjoy doing it.
Excellent. Well, we look forward to seeing more of your enjoyment of the charts again, Kev. And again, I appreciate your time. For those that want to see more of your and Pat's hard work, it's all available at northstarbadcharts.com. And of course, your Twitter handle at northstarcharts. You post a lot of stuff there that is, of the important variety, but again, more of your guys' framework and ideas are all available on the website, right?
Yeah, and we do our best to answer questions on there. So, when anybody's got anything they want to know, we do our best to answer the questions. And of course, the website members get all of the detailed trade information. So, and Pat's at BadCharts1 on Twitter. Don't ask me why he chose at BadCharts, but there you go. That's where you'll find Pat on Twitter as well. So,
yeah,
I think it's not Twitter anymore, of course, is it? It's X.
Well, we all know what we mean.
Don't worry, I'll get it. I'll get it in my head eventually.
The website formerly known as Twitter.
That's the one. Yeah, that's the one. I can't call it a tweet either anymore. It's It's not an X, is it? It's just a post, I guess.
Well, I don't think we need to be. I don't think we need to apply that level of accuracy to Twitter. As long as
people know where to find us, that's the main thing, Tom, isn't it? Yeah.
Exactly. All right, Kev. Appreciate your time. Take care.
Anytime, Tom. Thanks a lot.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.